We are going to jump into the confession box, a new segment that we've certainly is well and truly up and rolling at the moment, where you guys have the opportunity to tell us your confessions, whether it's investing related, money related. I'm waiting for one that is just life related, Ren.
Okay. Now, there are multiple ways that you can confess, and I should just clarify for Bryce before we go too far. It's not the confession box.
What did I say box?
Yeah, it's
Booth.
the confession booth. Just to save the comments. But there are multiple ways you can confess. We love it if you record a voice note. If you want us to change your voice, we can. But you can also submit a confession with your name or anonymously, and our producer Sophie will read it out. Soph, thanks for joining us again.
Hello, hello.
Now we've got 3 confessions here. The first is a voice note, and then we've got 2 written ones. So let's kick it off with the voice note.
Forgive me, mates, for I have sinned. I purchased my dream car, or what I thought was my dream car, at 18. I had no money. I was an apprentice living at home, walked into a dealership and walked out with a $26,000 car loan over 7 years at 14% interest. 14%. I was young with really no financial education. I didn't even know what interest rates were at the time, let's be honest. I wanted the car, so I had to have the car. No ifs, ands or buts. Anyway, fast forward 7 years, I ended up paying around $46,000 for this car, which I then went on to sell 3 years later for $16,000. $30,000 down the hole because I just had to have it. What a dum-dum. Anyway, now older, somewhat financially educated, thanks to Equity Mates. I see what a silly mistake that was, and yeah, I feel like an idiot for it. Anyway, love the show. Thanks.
Wow. Well, firstly, no one are idiots if you come on and confess in the Equity Mates booth. But thank you for the confession.
Yeah.
Jeez, the power of interest rates.
I know. 14%.
It's pretty criminal.
It's
pretty criminal.
It's a lot. Yeah. Well, I mean, they're not criminals, but you know, I think the car loans are such an American thing, and they're like slowly creeping their way more and more into Australia, and it's like as much as possible. Obviously, some people need a specific car for work or for whatever reason, but as much as possible, just pay cash for a car. Do not go into debt for a depreciating asset. Yeah.
Absolutely. Alrighty, well, we've got 2 confessions here that are centre around timing the market. So this one was written in, so thank you to the community member here. Take it away.
I first started investing in 2018 after seeing Afterpay on some websites and thinking it was a great idea. I bought Afterpay at $8.70. I wrote it up to $18 when regulation news came in and a family member warned me it could be bad, so I sold out at about $15. I think it went back up after the worries settled on regulation. However, when COVID hit, it dropped right back down to mid $9. Instead of just getting back in, I wanted to buy at $9, close to my original parcel price. But it only got to low or mid $9, so it was a lesson on trying to time the market versus just getting in the market. Then I missed out on it going all the way up to $150 in 2021. By not buying, I missed out on $20K plus, even if held until the Square buyout.
Wow.
That is brutal.
Absolute roller coaster here.
You know what though? Like, there is another way that you could. Obviously not great, the second part, but you did double your money on Afterpay.
Taking it from $8.70 to $15. 100% return.
So,
I think, just less than 100%, but still. I think a couple of things here for me. Firstly, news on regulation that didn't eventuate. Always risky making a decision when there's like news on what could come, if that makes sense. And then listening to family members. I know statistics show that so many people do listen to family and friends, but I remember that point in time in the Afterpay journey, and so many people sold out at that point in time on what was just a perceived regulatory change that really didn't eventuate. So bit of risk there.
Yeah, it's hard to say that though, because like for every example where the regulation didn't occur, I could probably think of an example where regulation did occur and it was the right move to sell. So I get that, you know, like,
fair.
I own tobacco companies in the 90s and there's rumours that they might get regulated. Like, it was the right time to sell then. Although they've actually done really well since, so not a great example. there's also you don't have to. You could have sold some and taken some money off the table, taken some risk off. But I think really the confession comes into its own when you're just anchored to an arbitrary price of $9 rather than buying when it was around $9 and the risk of regulation wasn't there. So that's where it's there's it's a cognitive bias where you anchor to a certain price. The classic example is when you've lost money on a stock and you don't want to sell until it gets back to the price you bought at.
I do remember this time so clearly though, when COVID came, and I remember looking at the computer screen and seeing $9. I was like, oh my God.
So for people unfamiliar with Bryce's personal journey, Bryce was still working at Woolworths at this time, and he cemented himself as a legend amongst the graduate cohort at Woolworths when Afterpay was... You were first spruiking Afterpay at $2,
$2.50,
and people at Woolworths still talk about that stock pick. And Bryce became known as the Afterpay guy, and it probably legitimized equity mates in a way in the people in Woolies' mind.
Yeah, it was a good story.
You haven't had a stock pick like that since?
No way. No, that was no. You only need a couple.
Yeah,
I haven't.
Kerry Packer had this famous line: "You only get one Alan Bond in your lifetime," and I've had mine. After he absolutely fleeced him on Channel 9. Maybe you're saying is you only get one Afterpay in my life.
I hope
and
not.
I've had mine.
Hope not. Anyway, good one. Thank you for submitting. Now another final one here. It is a bit lengthy, but stick with us because there's a lot of lessons out of this one. Over to you, Soph.
Hi, equity mates. Before getting into the confession, I just want to say I do use some numbers in the following confession, not to brag or show off, but just to provide some context that I think is somewhat vital to the situation. I'm about to turn 24 years old and would say I've been investing since I was 18 or 19, but have really only started to take it more seriously within the last year. I was lucky enough to get a corporate job straight out of high school and worked full-time while studying part-time at uni. I never received any inheritance or help from my family to get to my current financial position. Over the last 5 or 6 years that I've been working full-time, I've been on roughly the same average grad pay the entire time. As a result, I'd like to think my current financial position isn't too bad. I've got no HECS debt as I paid for my uni myself each semester and have got a net worth of roughly $150K that's currently split 40-60 in stocks and cash respectively. With this background, here's my confession. Despite knowing the benefits of investing, I prefer to hold cash in a high interest savings account. This isn't even necessarily from a risk perspective, but merely because I like seeing my cash balance in my bank account. There's something about it psychologically for me. It almost scratches an itch in my brain that's really satisfying. But there's also probably a slight risk aspect to it. Some of the stocks I've bought have been great, others not so much, e.g. most recently investing in lithium close to its peak and not selling when I made some gains. End result, losing close to 90% of all my investments. With that, we approach my next confession. I still hesitate whenever I try to make the decision to actually invest. Whether it's index ETFs or even blue chip companies, I always seem to make the decision to invest long into a bull run. There's even a running joke in my family that if anyone wants to buy anything in the market for a lower price, they should let me know, as whenever I decide to buy, that stock generally falls almost immediately after I get the buy confirmation from my broker. As of today, I want to invest more into the market, but I keep reading news articles that the market is hot right now and every company is extremely overvalued. Even the indexes seem to be hitting new highs every other week. While I know there's no way to time the market, I still feel like I've missed out yet again on another bull run. What would you do if you were in my position?
Wow, nice. Thank you, Soph, and thank you to our anonymous community member who has just submitted that confession. A lot in there, Ray. A lot in there.
So really two big confessions. The first one is holding 60% of their money in cash.
Crikey.
And then the second confession was about not investing because they're worried the market's going to fall.
Yeah.
So where do we want to start?
Well, I think you've got to commend your current position at 24 years old. Incredible, like solid start, no hex debt, and like you're still invested 40% of your cash. So you can't complain with that. But I do think for me, the second part is probably, I guess, longer term more detrimental than the first. And I think if you're paying attention to headlines, the headlines are going to be around year after year after year after year. And if you're not investing and you're trying to time it, you're just going to consistently miss out. I think he's actually, or she has actually noted as well, like, I feel like I've missed out on the gains. Markets are at all-time highs. Yeah, markets are at all-time highs because they keep on ripping.
Well, you have missed out on the gains. Like, like the fact that you've submitted it as a confession as well. I think, like, you're 24, you have 150 grand in liquid net wealth, and you've started investing. Like, you're doing a lot right. So don't be too hard on yourself would be a starting point. Yeah. And you realize that the feeling that you've missed out on the gains is the right feeling to have. That's your subconscious telling you, with your brain telling you probably should have been investing.
Yeah,
and listen to it.
And I think the view on investing has been clouded by perhaps being overweight and long. And
you're beating around the bush here. Your view on investing has been colored by your investing choices.
Yes, thank you. Investing in lithium and losing 90% is going to make you question the long term. Well, going to make you question the risk of investing. But I can say that there are plenty of ways that you could deploy the 60% cash that you have that is going to be low risk. Much lower risk than going into a lithium investment, and give you that sense of euphoria over a long period of time, just like you get from looking at your bank account and seeing all your cash. Can guarantee that if you're in a well-diversified ETF and in 5 years' time you're looking at that 60% in there, you're going to start feeling pretty good. Yeah.
We've been investing long enough now that we can start seeing like the gap between the amount we've invested and our portfolio is like you start to see that divergence. You see it on the compound money calculator, the Money Smart calculator, and you don't.
It's true.
Yeah, once you start to see like the power of compounding, it beats the feeling of having money in a high interest savings account.
Absolutely.
And so I think it's like you've just got to, like, you've been investing for 4 or 5 years. Like, that's great. Just keep dollar cost averaging. Do an amount that's like psychologically comfortable for you. You don't have to put the full 60% in if you don't want to, but just know that like over time that fear will subside as you go through market cycles and you see your portfolio grow over time.
And my final takeaway is to remove the emotion away from it and automate as much of that investing process as possible, so you don't even have to think about the markets being too hot, in inverted commas. Just get the money in there.
And well done. Like, you're doing great.
Yeah.
So don't be too hard on yourself.
That's it. No hex debt. That's solid. Well, thank you to Soph for reading them. If you would like Soph to read out your confession anonymously, or if you would like to submit yours in a voice note and have it played on the show, head to equitymates.com/contact. We would love to hear from you. The audience, the Equity Mates community, learn a lot from the confessions that come in. But that does bring us to the end of today's episode. If you really enjoyed today's episode, or you take a lot of value out of what we do, we would really appreciate it if you could leave a rating and a review in your podcast app. But Ren, we'll pick it up next episode.
Equity Mates! I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.